All right, let's get right into it. Right now, the entire financial world seems obsessed with the Federal Reserve. They're all debating soft landings and rate cuts, but honestly, they're missing the real story. We're tracking something much bigger, a massive structural shift that's set to hit in 2026. And believe me, it is not what you think.
What's coming in 2026 isn't a recession. It's something different. It's a liquidity vacuum, a moment where the money, the very lifeblood of the system, just stops moving. And the fuse? Well, it's just been lit by a staggering $2.5 trillion in new debt, all of it chasing the AI revolution.
So, over the next few minutes, here's what we're going to do. We're going to break down the three huge forces that are converging on the market. We'll show you why they are set to collide right in the middle of 2026. And this is the important part, what key signals you can actually watch to see this happening in real time.
Okay, section 1. So, like I said, all the media focus is on inflation and the Fed. But this obsession is kind of making everyone miss the point. While everyone's looking up, distracted, these three structural forces are gathering on the ground, and they're threatening the very plumbing of the global credit system. It's really important we get this distinction right. We all remember 2008, right? That was a solvency crisis. The problem was that the assets themselves, all those houses, were basically worthless compared to the loans. What we're talking about here is a totally different beast. This is a liquidity crisis. The assets could be perfectly fine, but that doesn't matter if there's simply no money available to buy or refinance them. The plumbing just freezes solid.
So, debating whether or not the Fed sticks a soft landing is, well, it's kind of pointless if the underlying credit market, the runway for literally every business that needs a loan, is about to be ripped out from under them. So, let's look at the first massive force that's driving this whole thing. And this one is a story of truly unprecedented demand for money. We're talking about the capital required to build out the entire infrastructure for artificial intelligence. The numbers here are just mind-boggling. We are looking at a projected $5 trillion in AI infrastructure spending over the next 5 years. And roughly half of that, a staggering $2.5 trillion, is expected to be financed with debt. This isn't a wave of new demand for money, it's a tsunami. Now, this creates a pretty stark choice for lenders, doesn't it? They've only got so much capital to go around. So they have to decide, do I refinance the old, slow-growth debt from, say, an empty office building, or do I fund the brand new, high-growth AI data center that's powering the future? I mean, who do you think they're going to choose? And this creates what's known as a crowding out effect. It's pretty simple, really. The safest, biggest borrowers, your Microsofts, your Amazons, they're going to get all the funding they need for their AI projects. But in doing so, they'll suck all the available oxygen, all the capital right out of the room. This raises the price of money for everyone else and leaves traditional borrowers completely high and dry. Okay, so force one was about demand for money skyrocketing. The second force is the exact opposite. It's about a massive source of supplies suddenly disappearing from the market. And for that, we have to talk about Japan. You see, for decades, Japanese pension funds and insurance companies have basically acted as the world's piggy bank, buying up huge amounts of US and European debt. Well, that whole era is coming to a close. We're looking at estimates of up to $500 billion of liquidity being pulled out of global markets as these giant institutions bring their money back home. So why is this happening all of a sudden? Well, it's a new regulation. It's called the Economic Solvency Ratio, and it has a hard deadline of March 2026. These new rules make it way more expensive for Japanese insurers to hold foreign bonds on their books. To comply, they really have no choice. They have to sell their US and European assets and bring that capital home. So just think about that. One of the biggest buyers in the world is being legally forced to leave the market. And that brings us to our third and final force, and this one is all about timing. A lot of people on Wall Street see a debt problem way out in 2027 and think, we've got plenty of time. This is a really, really dangerous miscalculation. So everyone knows about this thing called the maturity wall. In this case, there's $191 billion of high-risk, speculative-grade debt, think junk bonds, that is officially due in 2027. But here's the kicker. It's not actually a 2027 problem. I mean, think about it. No competent CFO waits until the last minute to pay a giant bill. The refinancing process for that 2027 debt has to start 12 to 18 months in advance. And what that does is it pulls that entire $191 billion wave of demand right out of 2027 and slams it squarely into the middle of 2026. Oh, and there's a nasty little surprise hidden inside all this debt. For years, a lot of these companies haven't actually been paying cash interest. They've been using these things called payment-in-kind loans, where the unpaid interest just gets added back to the principal. They've literally been paying debt with more debt. So the amount they now have to refinance has ballooned, making the math almost impossible in a tight market. And this is the moment. This is where all three of these forces, the AI debt bomb, the Japanese exit, and that early maturity wall, all slam into each other at the exact same time. It's not a slowdown, it's a mechanical failure. I mean, just look at the timing here. In early 2026, the Japanese repatriation hits its peak, sucking supply out of the market. At the very same time, AI demand is gobbling up whatever capital is left. And right then, bam! In mid-2026, that $191 billion wave of companies needing to refinance hits a market with no money and no buyers. Let's just be crystal clear on this. In 2008, the problem was bad assets. In 2026, the problem is bad plumbing. And this is why this is so critical. The companies themselves might be decent, their assets might be fine, but if there are no lenders around when your loan comes due, the quality of your business doesn't matter one bit. You can go bankrupt anyway. It's really just like a failed auction. Imagine you're trying to sell a perfectly good house, a great asset, but nobody in the room has any cash to buy it. The price doesn't matter. The availability of money is what matters. That's a liquidity freeze, and it always leads to panic. So, how can you actually see this coming? Look, don't just take our word for it. There are very clear data-driven signals you can watch for yourself over the next 18 months that will tell you if this is playing out. Okay, here's your watch list. First, keep an eye on the Japanese yen. If it strengthens really fast as we get closer to March 2026, that's a huge sign the repatriation is on. Second, watch credit spreads. That's the gap between safe debt and risky debt. If that gap blows out, it means borrowing costs for everyone are about to get way more expensive. And third, watch the private credit funds for something called gating. That's when they freeze redemptions and tell investors, sorry, you can't have your money back. That's a massive red flag that real panic is setting in. And all of this, all three of these forces, brings us to one final crucial question. For years, our entire financial system has operated on one core assumption, that there will always be a buyer, always a bid for an asset at some price. But what happens if that assumption fails? Is the system at all prepared for a world where, even for just a moment, there are simply no bids?